Hello and welcome to Unacademy IAS. With less than 48 hours for the UPSC Prelims, now you must focus on the revision of important graphs, formulae, and the ratios. Let's do that very quickly. Starting with the first Phillips Curve. It represents an inverse relationship between the unemployment rate as well as the inflation rate. This is the graphical representation. Next one is the Lorenz Curve. It represents the income inequality in a society. Along the x-axis, you have cumulative percentage population, and along x-axis, cumulative incomes that are generated. And this diagonal represents perfect equality line, and the gap between the diagonal as well as the Lorenz curve of a country represents how much is the inequality. The curve, as it moves towards the perfect equality line, it simply means the inequality in the society is coming down. Using this, we also calculate Gini coefficient. And whenever the Gini coefficient is 0, it represents perfect equality. And when it is 1, it represents perfect inequality. Next one is the Laffer Curve. It provides a relationship between the tax rates and the tax receipts collected by the government. The basic idea is when the tax rates are increased, the tax revenue collected by the government also increases. But at one tax rate, the amount of taxes collected by the government will be the highest, and that is called as optimal tax rate. After this, if the government will increase the tax rate, the receipts rather than increasing will keep on decreasing. That is Laffer curve. Next one is Kuznets curve. With the development, the income inequality initially will increase, but over a period of time, over a period of time, the income inequality will keep on decreasing. This is the representation of Kuznets curve, that is inverted U curve. Then there is a fifth, that is J curve. In the context of rupee depreciation or rupee losing value, right, there could be a connection with this kind of a curve. What it simply says is, whenever a currency is devalued, to begin with, the trade balance worsens. That is, the trade deficit increases because of higher sudden imports. But over a period of time, the trade balance will improve because the imports will go down and the exports will start to increase. That is basically the representation of the J curve. Now let's look at certain important ratios from the financial market. MCAP to GDP ratio. It is the market capitalization of all the listed companies divided by the gross domestic product. This ratio will help you in identifying whether the market is overvalued or undervalued. In the same context, please remember there is also one more index called as a volatility index to determine how much is the volatility in the market. Then there is earnings per share, EPS, earnings per share. It is used to identify what kind of stocks you want to invest in, how these particular stocks are performing compared with other kinds of or other shares of other companies. The formula is net income divided by outstanding shares. Then there is a return on equity, ROE. Profit, the profit is profit after tax here divided by equity. But what is the meaning of the return on equity? The return on equity basically represents how much is the profit generated for every 1 rupee invested by the shareholders. That is the return on equity. Fourth one, price to earnings ratio, PE ratio. The market price divided by earnings per share. The PE ratio basically provides you the information regarding how much the shareholders are willing to pay to earn a rupee in terms of revenues. That is price to earnings ratio. Fifth one is a debt to equity ratio. The total amount of liabilities are divided by the total amount of shareholders' capital. This will help us understanding whether the company is over leveraged or under leveraged. Then there is a currency ratio or current ratio. It is the current assets divided by current liabilities. Whatever liabilities that the company has to pay in a short duration, does it have sufficient amount of assets to take care of it? That is the current ratio. Then there is a quick ratio. Within the current assets, there are certain assets, for example, inventories. The inventories cannot be quickly converted into cash. There are other forms of assets, for example, the cash held by the company, the cash deposits in the banks, etc. So these kind of, right, let's say current assets which are considered as quick assets are taken. So quick assets divided by current liabilities will give you quick ratio. Then there is a eighth and the final ratio from the financial market, interest coverage ratio. Earnings before interest and tax divided by interest payment. This ratio will basically tell you how much is the total amount of money that the company has whether it is sufficient to pay the interest payment or not. This is basically the idea of interest coverage ratio. That is, how comfortable is the company in terms of meeting interest payment liabilities. Now, important formulas: money multiplier. The formula is 1 upon reserve ratio, or M3 upon M0. And basically, the meaning of money multiplier is, if there is a change in the high powered money as a result of this, how much will be the maximum change in the overall money supply in the economy? How do we measure the money supply in the economy? We have M0, that is high powered money, currency in circulation plus banks deposits with RBI plus other deposits held by RBI. Then we have M1, that is narrow money, currency held by the public plus demand deposits with the banks, demand deposits with the banking sector, that is, which will have very high liquidity, plus other deposits held with the Reserve Bank of India. Then you have M2. M2 is M1 plus post office savings deposits. The post office savings deposits are added separately because these have lesser liquidity compared to the demand deposits held by the banking sector. Then there is M3, the broader money. M1 plus time deposits with the banks. Time deposits have lesser liquidity compared to the demand deposits. And then we have M4. M4 is M3 plus deposits with the post offices except the national savings certificate. Then there are formulas for national income, gross domestic product. There are three methods to calculate GDP. One is the production method, output method, or value addition method. How do I calculate the GDP? You start with the factor cost. GVA at factor cost plus production taxes minus production subsidies will give you GVA at basic prices. Then you take the GVA at basic prices, you add product tax plus minus production subsidies. You get GDP at market prices. Then there is a GDP calculation through income method. You take the sum total of all the factor incomes generated within the Indian economy, within the territory of India, and get the sum total of it. That will give you GDP through income method. Third one is expenditure method. C plus I plus G plus X minus M. C is the total consumption expenditure. I represents investment expenditure. G represents expenditure done by the government. X represents exports and M represents imports. Now, before I go forward, whether you calculate GDP through first method, second method, or third method, please remember the number should be one and the same. Then there is also GDP deflator, which is also considered as implicit price deflator. We have CPI, we have WPI. But CPI, WPI, both of them work on a concept of a basket approach. There are basket of goods or service or goods and services in CPI, and in WPI only the basket of goods. So there is limited coverage when you talk about inflation through CPI and WPI. But when you talk about GDP, it represents the market prices of all the final goods and services which are produced for a specific time period within a specific territory. So when you take nominal GDP, that is the GDP which is calculated using the current market prices, and the real GDP, GDP which is calculated using the base year market prices. Basically, it represents how much is the increase in the price levels of all the final goods and services produced. That's the reason GDP deflator is considered as an implicit price deflator. Next, GNP. It is calculated by adjusting GDP with net factor income from abroad. That is the factor incomes which are generated by Indian residents but living abroad, minus the factor incomes which are generated by non-Indian residents who are living in India. NDP, GDP minus depreciation. Depreciation represents consumption of capital. NNP, right, basically GNP minus depreciation. And finally, NNP at factor cost, which is the purest form of income, purest form of national income. It is calculated by NNP at market prices minus indirect tax plus subsidies. We also have per capita income, that is calculated by national income divided by population. We have import cover, the total amount of Forex reserves divided by the monthly imports. This will give you the import cover. According to economic survey, the import cover for India is around 11 months, which means we have sufficient amount of Forex reserves to continue to import for 11 months. Inflation rate, this is the formula. Deficits, there are four types of deficits that are published right now by the government. We have revenue deficit, revenue expenditure minus revenue receipts. Effective revenue deficit minus grant for creation of capital asset. We have fiscal deficit that represents the borrowings done by the government of India. Formula is total expenditure minus within the bracket revenue receipts plus non-debt creating capital receipts. And finally, we have primary deficit, that is fiscal deficit minus interest payments. So these are the important formulas, ratios, as well as the graphical representation. Please go through this once more. The document link for you to download this particular PDF is given in the description part of the video. All the best to all of you. Look together, let's crack it.